Okay, so today we're going to go over the basics of spread options, some terminology that we use more in spreads than in normal normal options, and we went over the terminology in normal options, so they're going to be similar. So I'm not going to re-go over some of the terminology we already went over. I'm just going to go in more in depth in the ones that I use specifically in spreads. So we're going to go ahead and start with that, and then I'm going to show you how to set it up, who can do it, why we do spreads, why I personally do spreads over naked options, and then I'll go to a Robinhood account and then also a Tastyworks account on the computer and show you specifically how to set up those trades on different accounts and different brokers. I don't have Thinkorswim right now on my computer, so I won't be able to do that. But you can look that up pretty easy. All right. At me in the DMs, at me in the trading chat if you have any questions. I'm gonna be on a presentation mode, so I'm not gonna be able to see you guys as much. All right, let's roll. Make sure OBS is catching it. All right. So our spread basics. This isn't as fancy as Broham's, but as quick as to the point. Who can do spreads? Anybody with a margin account can do spreads. Spreads are great for small accounts. If you're trading options already with a Robinhood account, you automatically have a margin account, so you can do spreads. And if you're struggling with naked options, that's a really good reason to kind of switch over and say, all right, maybe I should start doing spreads now. All right, so some of the terminology, we went over buy to open and sell to open yesterday. That will also be, you'll hear me talking, that's your long strike is your buy to open, and your short strike is your sell to open. And so if you need a recap of what buy to open and sell to open is, go back through the other video from yesterday. And so a debit spread is an option strategy involving the simultaneous buying and selling of an option of the same class with different strike prices requiring a net debit outflow of cash. So you're paying for it. So you would have, let's just say, your buy to open a 375 on SPY, and then a sell to open a 380 on SPY. Your net, you're paying for that position. Credit spread is opposite. Your option trading strategy involves selling and buying an option of a financial asset having the same expiration but different strike prices. So let's just say you sell to open a 90 and then buy to open a 95 call, or sell to open a 70 put and buy to open a 65 put. And so they're a little different, but that's going to net you a profit and a credit instead of having to pay for it. And so that's one of the things about spreads is you will have to they will hold a collateral from it, which will be the buying power reduction, but you don't have to actually. The probability of profits is great. Come here. Come here. 1 second. So that goes to POP, P-O-P. That's our probability of profit at expiration. And so when I say probability of profit or POP, I always mean at the expiration. And so that's one thing that, yes, it may be profitable beforehand. Yes, it might not be profitable beforehand, but it's always probability of profit at expiration. Next would be our P50. That's probability of 50% of max profits of that contract. And then so max profits is the maximum amount. So when you have spreads, you're capping your maximum gain. Unlike with a naked option, with like a naked call, you could get unlimited gain as long as it continues to move up. With a spread, you're capping it at your short strike or at your long strike. However, My bad, this fucking headset sucks. Alright. So with spreads, you have a maximum profit that you're able to get, which is cool because you give yourself a risk to reward that you know your risk and you know your potential rewards. Collateral, you only need it in credit spreads. That's the total amount of cash needed for the max loss, which we'll go over that here in a few. Max loss is, of course, the maximum amount of risk you are taking on that trade. So if you're paying 300, that's your max loss. If your collateral for a credit spread is 500, that's your max loss. You can't lose any more. As we get into more naked, as we get into more advanced strategies, you'll learn that there are strategies where you have damn near infinite loss. And so, but that's a whole different point. The break even is the break even point at the market price on an underlying asset must reach for an option buyer to avoid a loss if they are exercised a contract of the option. That would be at expiration. So the break even is always at expiration. You look at them with credit spreads a lot and with iron condors and some of these other ones. Not necessarily as much with debit spreads because a lot of times we're just playing the momentum. Your wings, you'll hear me say that. Your wings is the width of your strikes. And so if you have a buy to open and sell to open, they're $5 wide. Those wings are $5. At the money, ATM, ITM is in the money, OTM out of the money. And I'm pretty sure we went over that yesterday. At the money is right at the underlying stock price. In the money, if you have a call, say the stock price is 370 and your call is 365, that call is in the money. Vice versa, if you have a call and the stock price is 370 and your call strike is at 375, that is out of the money. And then if the stock price is at 370 and your strike price is at 370, that's at the money. It's right at the underlying stock price. So why do I use spreads? It's Greekless, so you get rid of pretty much all your Greeks. You can focus on the movement of the stock. You have almost no vega, you have almost no gamma, and you have almost no theta. What does that leave you? That leaves you with your one Greek of delta. So you get rid of all these other variables and you get to focus on one. You don't fully get rid of them, but you minimize them, which makes your contract volatility. It makes your contract way less volatile for less movement in downside and also less movement in the upside, but it protects you from downside risk. Personally, I'm a very risk adverse trader. I don't like heavy risk, and so I want to minimize my risk at all times to keep consistent gains. They're safer. The lowest probability profit I use is about 45% probability profit at expiration. Spreads are great for swing trading. You can go further expiration contracts and get right at the money for further expiration contracts for a lot cheaper. They're very good to build small accounts. You can start it out with $22,000. Get at the money strikes, like I was saying, which that brings your probability of profit greater. They're good risk to reward. Usually for debit spreads, I do about a 2-to-1 risk to reward. You're risking 1, you're trying to get 2. And then for credit spreads, it's a little different. I have a formula that I use. I'm not going to explain that right now, but the probability of profit makes it worth the risk to reward for credit spreads. And spreads are great for consistent gains. If you're having trouble getting consistent gains on naked options, I highly recommend going through to spreads. That's what I did. For the longest time, I was having trouble with naked options, and I started getting into spreads more, started looking at them. They're not that, oh, I'm going to make 1,000% or 100% right away in a small amount. It's like a turtle. It's like the tortoise and the hare. This is steady. It's going to be steady every time. So that's what I really like. So this is just a little, just an example of two different contracts, one a naked and one a debit spread, to show you how, you can't really see it too much, to show you why I do spreads. So if you look here, this is just SPY, It's an at the money strike, 376. The stock price is at right now is at 375.68. So if you go out to February 19th, that's about 35 days. At the money strike, so 376 stock price, strike price, you're paying $822. Okay, that's first. You're paying $822 to go out to fucking February at the money. Next, if you look right down here, so the stock price, if it goes down to 375, if it drops 68 cents, you are already out $46. Yes, if it goes up to 2 points, you're up $100, 109. But say if it goes down 2 points, you're down 94. So you're having a little more, your risk is a lot worse. And then the longer you hold it, the less likely you are to keep the profits. And so then if you go to your debit spread over here, it's right at the money in February, just like everything, just like the other one. It's only costing you, I forgot to put the net, but it's only costing you about $200. Total cost of the first one you're buying is 800. The one you're selling, so you're receiving the credit for the one you're selling, is 593. So it's about $200. 209 is the, and so then, if you look right here, if it goes up $1, just like in the other one, yeah, you're only making $12 instead of $58. But if it goes down $1, you're only losing $6. That's where I like. You don't have, you can withstand more risk. You can withstand more downside with these spreads. And so then we're just going to go straight into it. A debit spread, so what you're going to do is you're going to buy one at the money or in the money strike, and then sell one out of the money strike. And so that what that does is that gives you a net debit that you're paying. And so usually I go 30 to 90 days out till expiration, DTE, days till expiration. The further out, the safer they're going to be. And so, because you have more time in case it goes against you. Cost of the trade is the net debit between the two strikes. The max loss is your cost of trade. Somebody add me. What website can you pull up these charts on? That is on Options Profit Calculator. Can everybody hear me fine? Or is it just Jono that can't hear me? Okay, cool. So debit spreads are generally best in low IV environments. So if it's under a 50% IV, then that's what you're going to want to do a debit spread for. I like debit spreads. They're good with like the watch list, with anything that is more of a momentum trade. You can be a quick in and out for like you get it one day, get out the next day. They're always swing trades. Debit spreads are always swing trades. I mean, yeah, pretty much, because you have to let your short strike, that's your sell to open, your short strike, you have to let your short strike kind of decay a little bit. Generally, what I like to do, I said this already, I want a 2-to-1 risk to reward for debit spreads. So if I'm putting up $50, I want my max profit to be $100. If I'm putting up $100, I want my max profit to be $200. Generally, that gives you about a 44% probability of profit. My percent button doesn't work, so. And with debit spreads, you want them to expire in the money. Unlike credit spreads, so with credit spreads, you're going to sell one out of the money strike and then buy one further out of the money strike. Just like debit spreads, 30 to 90 days till expiration. Cost of trade is the difference between the strikes minus the total credit received. So let's say you have $5 wide. Let's say in SPY was at a 370, 375 roughly. We're just going to be easy. We're going to say a 360 was our sell out of the money strike, and then a 350 put. So it's opposite. Let me know if I'm going too fast for you guys too. I know this is kind of a lot of information.
Hunter, you doing this? You back yet?
Yeah, my fucking headset keeps turning off on me.
Oh, I was gonna say, are you doing this on Zoom or are you doing it just on here? Because I think you reached the maximum people that can watch you.
Yeah, I'm just doing it on here. We can talk to Playboy about getting a Zoom set up.
Yeah, you can get that next time. Just so you know,
Okay.
I know I saw like one or two people say that they can't
It's being
get on.
recorded, so
Oh, you're good then. All right,
everybody can go
and
back
nobody
through it.
has anything to worry about.
Everybody can go back through it.
All right, I'm still listening. He's spitting game, bruh.
Bro, my fucking headset will not stay turned on.
Man, what kind of headset you have?
I don't even know. My mom got it for me for Christmas.
Oh, I have that cool one Playboy sent me. It's a Microsoft Surface one.
It like doesn't recognize that I'm doing something, so it fucking just keeps turning off because it thinks I'm not doing anything.
Do you think it might be the activity sensor on Discord itself? Because it turns off your mic with sensitivity. Do you think maybe that's what it is?
Possibly. That's actually a good idea. Somebody else can screen share my screen. They did that yesterday too. So if you guys want to do that, that's perfectly fine. And I know I'm going a little fast, but I'm going fast through the slides so I can actually show you guys in person on an actual contract. Because it'll be a lot easier looking at the contract, at the option price, and everything like that. And so with credit spreads, we're selling one out of the money. It's always a high IV, so that way, so like you make the most out of your IV crush. And then with credit spreads, you're collecting a third of the width of strikes, which I'll explain that too. Generally, your probability of profit for credit spreads is about 67%, which is fucking great. I had a Zoom one. I had a Zoom put credit spread that was a 350, 340 strike. And so what that means is with a put credit spread, then you want them to expire worthless. You want them to expire out of the money. So it's a bullish put credit spread. And so then you want it to go up. So Zoom, I had it. Zoom was at 360 when I got it, somewhere like that. It dropped down to 340 and then came back up to 380, and it would have still expired worthless because it closed at 380, expired worthless, and it would have gotten 100% full profits. And it did get 100% full profits. So that's all for those. We're going to go into actually doing this shit. Because I know that's
Did
a
you get
little.
that Zoom spread?
Say what?
Did you get that Zoom spread on Friday? The one with
No, because
the.
I didn't trust the market.
Oh, gotcha. Okay, that's what you're talking about.
No, I put just like 2 weeks ago, I think. I got a Zoom put credit spread, and just like a cheap one for fucking January 15th, shorter expiration than I usually do. But it dropped heavy, and then it just came back up for whenever, and then it expired worthless, and I was like, whew, I almost cut it. So I'll do an example of a debit spread and how to do it. This is Robinhood. I don't use Robinhood, but I know a lot of you do. So this is an easy way for me to show you guys how to do it. This is on Robinhood mobile, or not mobile, fucking desktop.
So if you were to want, I'm just doing SPY because it's easiest. You want to do a debit spread. So you're going to say buy. You think it's going up. I generally do the next expiration out for monthly. I don't normally do weekly expirations for spreads because your spreads are going to have your bid-ask spread for these are going to be horrible for the most part if you go out into weeklies. So you click right here on this plus button. So 1 at the money, and then you go up, and you go, I generally do 5. 5 is a good start. 3 to 5 is a good start. 5 is ideal in my opinion. And then as you get more experienced, you can raise up, you can widen your width of your wings. So you sell this one here. So right up here, it says buy. You click your buy, and you're going to buy your at the money or in the money. I generally just do one at the money. Then you click sell, and you're selling 5 out of the money. So what this is saying is essentially just like you saying that you think it's going to go from 375 to 380 by February 19th, which it was just 380, what, 3 days ago, 4 days ago? So net, this is total costing you $300. If you look, if you were to just get this naked option, it's costing you $938. So that's where you can get right at the money, further expiration for a third of the price. So you have 301 is our total cost, right? We have $5 wide spreads. I'm going to do the search bar. So $5 wide minus, we're just going to round it down to 3 because that's an easy number, minus $3. If you guys see my search bar right up here, I'm doing the math, equals $2 max profit. That's how we calculate our max profit. So if we were to do, I'll do another one for you guys real quick. We're going to exit those out. Say I'm going to do, and I wouldn't mind doing that with, even though it's not a quite a 2-to-1, but it's got a really good probability of profit. And it would be too far out of the money for me to go 380 and 385. I don't like going out of the money more than $5. That's for my short strike usually. $5 or $10. I don't like that. So I want to keep it tight. That's why we're doing spreads, so we can keep it tight at the money to keep our probability of profit. This is more statistical. So let's just say, for demonstration purposes, we did the 380 by the 380, and we think SPY is going to fucking fly, 385. So now we're only paying 2.45. So 245. We all know option math. If you don't know option math, learn it. We've taught you guys before, I think, pretty sure. So $5 wide minus 2.45 would be a 2.65 total profit. That's correct, right? I didn't even use a calculator. No, it'd be 2.55. 2.55 max profit. So you're gaining $50 extra essentially for going out further. And through Tastyworks, I'll show you guys the actual probability differences between these two trades. Right now, everybody uses Robinhood. A lot of you guys use Robinhood, so this is just an easy way to show you how to do it on Robinhood. So that's for a debit spread. So now think, same situation. You think SPY is going to go up. So, but you want to do a credit spread. You want a little safer passive option. Credit spreads always have a little higher risk to reward. They're a little safer. Notice right here, it has your chance of profit. That's your delta essentially. Normally that's your delta. So like I said yesterday in our or Saturday in our stream, your delta tells you the probability of profit at expiration. Well, we'll go to our Greeks. Our Greek is a 35 delta. So that means 35, that means it's a 35% chance of this becoming in the money at expiration. What do we want with a credit spread? We want it to stay out of the money. And so 35, so if it's a 35% chance of it being in the money at expiration, that means it's a 65% chance of it being out of the money at expiration. Does that make sense? Okay, let me know if I'm going a little too fast. I do see questions. So the 3, the 5, yeah, where did the 5 and the 3 come from? The 5 is the width of the spread. So you got a 365 and a 370 or whatever. And the 3 is the price you pay. Okay, continuing on to finish for this trade. So we want to collect about a third of the width of the strikes. Say that again. So his question up here was, where did the 3 and the 5 come from? The 5 was the width of the strikes, so it was a 370, 375, 380. So those are $5 wide, and then you're paying $3 for it. So that's where the 3 is, and then your max profit is $2. Yes, we want the credit spread to stay out of the money. We want these to expire worthless. We want to collect full credit. So with a debit spread, you want your premium of your contract. That's the price you pay. With debit spread, you want the premium to go up. With credit spreads, you want your premium to decay. You want it to go to zero. You want no premium left in that contract. So 365, 360. I don't even know if this is correct mechanics, but $1.01. That's fine. It's not quite a third of the width, but it will do. So now we have a $5 wide put credit spread. Our total credit we're receiving, so if SPY stays above 365, right here, our short strike, you receive full credit if the underlying stock, SPY, stays above your short strike, that's your sell, at expiration. So if SPY stays above 360, 365 until February 19th, then you receive the full $1 max profit, so $100. That's why generally we like to do a third of the width of strike, so I'd probably do a 370, 375. SPY is really put skewed, or SPY is really call skewed, so I'm going to leave it at this, because it's easy, it's a $1. So now we have $5 wide, peep up here, we have $5 wide, minus the $1 that we're collecting. I'm rounding this down. So we're collecting $1. So this brings us to our maximum loss, $4. So I know people think, well, shit, it's a fucking. I'm risking $400 to only make $100. Yes, yes, you are. But the probability of getting that max profit at expiration is to receive max profit, you have to go all the way. Your long strike has to be breached. So your 3. Wait, that's a debit spread. Why did it do that? Oh, I see why. Hold on. Sell 360. Sell 365. Buy 360. There we go. Total credit $1. So to receive your max loss is going to be if the short strike gets past, if the stock price gets past your strike price, your long strike price. So 365, 360 is your long, your buy. So this one, if it gets below 360 by February 19th, if it closes below 360 by February 19th, then you get max loss. What's the probability of this? You have a 76% chance of this being out of the money at expiration. So if you think about it, your probability is incredibly higher than your risk to reward. So you have to always put that in concern, like thought, when you are doing credit spreads. Your probability will always be incredibly high. Your risk to reward will be lower, but your probability makes up for it. So this is how to do it on Robinhood. I'm gonna switch over to Tasty because this is what I use, and it shows you a little better visual of your spreads and how to do them. Let me know if you guys have any questions. Absolutely, spreads are great for starting with low capital. I don't know how to do Webull. I will find a video for you though. I will find a video. So we're going to change over to Tasty to show you more of a visual of how these work, because Tasty has that. Tasty. So we're going to go to the same stock just because SPY is easy. Everybody knows what the S&P 500 is. This is my hedge. I ended up getting a 375. So this is actual trade I have on. This is my hedge. I have a 375, 370. So I'm buying the 375. I'm selling the 370. So this is a put debit spread. I have a 49% chance of becoming in the money at expiration. A 56% chance. So this is your P50. A 56% chance of getting half of your max profit. So we'll do our max profit. So we have our $5 wide minus the 163 that we're paying gives you a 3.37 max profit. So $337 max profit for risking $163. That's a 2-to-1. That's a 2-to-1 I'm looking for. Look at your data. So this is where your other Greeks get in. We went over the Greeks on Saturday. Go back over those videos if you need to. So theta, remember, bitch ass theta. Nobody fucking likes theta. But with spreads, you make theta your fucking bitch. We're going to go, so if I were to just have a naked option on this, every 1 day I'm holding this contract, the contract is losing $12 worth of value. Throw your spread on here. Every 1 day that you're holding it, your contract is gaining 71 cents of value. So if the underlying stock is at 372 at expiration, what happens, or how much do you make? You don't make as much. I'll show you. But I don't hold them till expiration. You don't generally hold them till expiration. I usually cut them 21 days till expiration. And I'll explain that in a minute. I'm going to go over this though. So theta you have, so every day you're holding this contract, your contract is gaining 71 cents in value, 72 cents essentially in value, just by holding this contract. So this is our beautiful old analysis tab. A lot of brokers do have them. I don't exactly know which brokers have them. So your question was, what happens if it's at 372 at expiration? Because it has breached one strike but not the other, you don't get max profits. But you do get some profits. So at expiration, if it's at 372, you're getting $123 profit. You're risking $157 max. So if it's above 375 at expiration, that's your max profit loss. And if it's below 370 at expiration, that's your max gain. So with theta, so next we'll go to gamma or vega. So we were talking about vega was so if you have just the at the money, every $1 or every 1% your IV changes, your contract is gaining or losing 47 cents. Well, you have 47 cents net, 47 cents minus 46 cents. Now, every 1% IV is changing, your contract is only changing 1 cent. Pretty much nothing. It doesn't even bother it. So that's where you don't really worry about these other Greeks nearly as much. A +2 and a -2. So when you're adding up your Greeks, your long strike is going to be your plus because you're adding a contract. And then your short strike is going to be a minus because you're selling the contract. So plus 47 minus 46 is a net of +1. +2 minus 2, net 0. Theta 2 plus, so minus 12%, minus 12 plus 13 is almost a +1. Get it, T-Bone. You're the one that did it yesterday. That's perfect. Or Saturday. So now we'll go back. We'll go to our example. So our put credit spread of 365 and 360. We have a net of $1. Notice how Tasty gave me a little better credit too. Oh wait, I did this wrong. $106. And you can see this little thing right here. This green is where you're in profits, the red is where you're not. It's the same as this analysis tab, but without having to actually go to the analysis tab. So now we have on a credit spread. We have 30 days till expiration, DTE. 365, sell to open, 365. Buy to open, 360. Net, we're receiving $1.06, 1.06. Net, that creates our max loss to be $394, so $5 wide minus 1.06 is $394. That's your max profit, or that's your max loss. That's also your buying power reduction. With Robinhood, they might try to just take out the whole 500. I don't know for sure. They used to. So then that gives your probability profit a 65% chance, probability max profits. Probability of becoming 50% max profit is 85%. That's nice. You have your 5 delta and a positive 2.2 theta. So every day you're holding this, your contract is gaining 20 cents. we'll go back to our analysis tab. So this is just for this one contract. As long as the underlying stock stays above this 365 level, at expiration, you're going to receive full credit. These are going to expire worthless, and you're going to receive this full credit. If it breaches it and breaks it, as we'll go through this a little more, but I'll show you guys how to strategies on defending them and adjusting strikes and things like that. That's for another day, a little more advanced. So right now we're looking at, as long as it stays above 365 at expiration, we're going to collect the full credit. If it breaches it, generally what I do, if it starts to breach it, I might just cut it. If I'm not feeling it, if it's looking super bearish, I might just cut it. Or you hold it and see what happens. I mean, that's all you're risk adverse. Usually I don't try to, usually I only play with 2, maybe 5% of my portfolio per trade. So I'm not very, I don't go crazy with my shit. That was my very next thing. Do you ever combine calls and puts for spreads? That is what we call an iron condor. So with an iron condor, that's 2 spreads mixed with 1. Usually they're credit spreads. And what that is you're playing the range. Same mechanics. You want to collect 50%. You want to collect 1/3 of the width of strikes. So if you have $5 wide strikes, you want to collect about $1.50. But you can go further out. And especially like right now, when stocks are playing within a range, they're good. These are fun to have. These are cool. This will work. $1 works. I'd say $1 is the least you want. SPY has really low IV, so I generally wouldn't be doing SPY, and that's why we aren't collecting the amount of credit that we would want for the same probability of profit that we would want. So kind of just bear with me for this part. So right now, and I'm on February 3rd. February 19th is what I want. Perfect. Now we have $1.83 credit. That is fucking perfect. So we have the 360, sell to open, 360 put, buy to open, 355 put, sell to open, 390 call, buy to open, 395 call. So we have 2 different spreads on in one trade, 4 legs of this trade going at once. Net, we are collecting $1.83. Our max loss is $317, 3.17, $5 wide for both strikes. You have to keep the strikes both. You have to keep the strikes the same though. So when you're doing this, you can't have a 360 and a 350 and then have a 390, 395. You want to do a 360, 355, 390, 395. Keep them the same. So we are collecting more theta. So now we have a positive 2. So every day we're holding this, our contract is gaining $2.67. Even if SPY does not fucking move, our contract is gaining this money. Net, we have a -3 delta. So we'll go to our delta values. We have a net -20 delta and a +12 delta. So that's a -8. A -28 and a +24. That would be another net of just about 4. So 4 plus 8 is 3. It's a little different because it's like more decimals out here and shit, but they don't show me all that garbage. Tasty just has it right here. They make it simple. So your net probability of profit is 47%. That's beautiful. You have them $5 wide. And so what this does, we'll go to our handy dandy analysis tab. As long as SPY stays within this range, by expiration, you get max profits. If it breaks out of the range, you get max loss. So it's cool. So do spreads work well? Still like $100 gains or on lower, which is GE, BT. I'll show. Let me see. Okay, do you have to put 1,000 up? Okay. Oh, absolutely. My average spread only cost me about $250. So stay woke. I'll show you. Like, this is SPY. Even on SPY, it's a $300 stock. Your average spread, like, your spread can be $290 for a $5 wide spread. So you said GE. That's a good one. I personally wouldn't do a spread on GE, and here's the reason why. Because you're able to get so close at the money or in the money with this further out expiration, then I would just go naked. You still have next to no theta, you have a good delta, and your probability of profit is decent. It's only costing you $45 to go one out of the money. If you go right in the money, then you have a 61 delta, negative 0.93 theta. So next to no theta, it's only costing you $87. So with these low costed stocks, I usually won't. Like, this stock's only costing $11, so I probably wouldn't do a spread on this. If it's, so what was the other one? Here's the other examples. BT. How much is BT? $16. I probably, see, like, look how expensive these are. Look at the IV right here. 227% IV. I would do a credit spread on this one. You have such a high IV right here. You could sell your 15, buy your 10, you're collecting 239 profit. So you could even go down a little bit. You're collecting $160 for a 12.5, 7.5, $5 wide strikes. 62% probability of profit, that's perfect. 73% probability of max profits. Or you can go out the next expiration, go down a little further even. Oh damn, the bid ask is too wide on this one, you wouldn't be able to do it. See how the bid is 0 and the ask is 450? Can't fucking play with that. I don't fuck with those. I like my bid ask tight. This $20 is $30 is fucking far enough. Like the generally, if it's like $50 or more, I'll do a spread on it. Like GM's a really good one. Probably if the market's looking healthy, I'll get another spread into it. And so if I were to get GM, the stock price is at pretty much $50. I would just do a 50 and a 55. There you go, buy one, sell one out of the money. So you buy one at the money, sell one out of the money. Net, this is only costing you $175. This is why these are so good for fucking beginner accounts, for people that have small accounts. Roku put credit spread, peep it. Are you looking for Roku to go down? Yes, so it'd be a call credit spread. Hold up, let me finish this GM one. So GM, if the market's good, I really want this GM one. So if you were to do it, like, you're able to hold this thing for 60 days with a theta of only 14 cents. and it's only costing you $175. If you were to do a naked option, it's costing you $415. Three times almost three times as much. We'll say a third still. Third more, you have three times the theta and three times the delta. So if it moves against you, it's affecting you way fucking more. If it moves towards you, yeah, you're making way more. But that's not what we're looking for. I'm looking for the least amount of risk. It's what I care about the most. So its IV is about 50. Because it's got lower priced premium and it's a lower price stock, I would stick with a debit spread instead of a credit spread. IV rank is another thing. I'll have to go into that when more people get Tastyworks, because it's pretty much only a Tastyworks thing. So Roku, 60 days out, 30 to 60. I'm a further expiration. Shorter expirations give you quicker profits. Roku's IV is at 70. Its IV rank is at 19. A little low on the IV rank. Close here. Yeah, notice Roku's IV rank is actually super low in general anyway, so it's not a big deal. We got a 70 IV, so we'd be doing a credit spread. Glacier said that he thinks Roku's going down. So what is the max we think Roku would be at? What's the all-time highs? All-time highs is at 425, so we want to go a little above that. So about, we'll say 440, somewhere around there. And that's how I determine my strike prices sometimes too. Say it's at all-time highs, I think it's going down. Go a little above that, give it some wiggle room, and fucking there we go. Beautiful. 125 credit. Your probability profit is 69%. And then you're receiving 125 credit. It's only costing you 375. You have a 0.54 positive theta. And then if you're really, really bearish on it, then you can drop it down a little bit. Roku has a pretty wide bid ask. You can, if you're really bearish on it and you think like Roku is not gonna fucking go up, you can go down a little sooner, collect a little extra credit, and then it's, if it goes down, you make more. So that's just like optimal mechanics. Say a third with a strike to keep your probability profit the most, but you can always kind of tweak it a little bit based on your bias of that stock. I'll look at Neo. Yeah, I'm super bear on Roku too. I think it's kind of showing signs of exhaustion. I would probably do a 425, 430 personally. I wouldn't go too much further out. I mean, yeah. It also depends on like your volume and open interest. Tastyworks doesn't do NYSE volume, so the volume and open interest are a little worse on Tastyworks. But I deal with it. Their fucking fills are amazing. Neo. So Neo only has strikes every $5. That's wonderful. Got an IV rank of 11. Doesn't matter. IV of 112. So we are going for a credit spread. You can still do debit spreads if you want extra money. Like you could do a 50, 55. It's only costing you, like, debit spreads are always going to cost less usually. So like if I don't want to put up as much as a credit spread is going to make me put up, I'll just do a debit spread because it's cheaper. There's no harm, no foul in doing that. Like, we can tweak the optimal mechanics to what we want. These are just how quote they're meant to be type shit, you know? And because we're getting rid of our Vega pretty much, like if you still have almost no Vega, you have a 1 cent Vega, then it doesn't really matter too much. So I would still do it. I would still wouldn't mind doing, like, if I'm kind of skeptical, like, oh, I think Neo's gonna go one way, but I'm not 100% sure. But I want to dip my toes into it. I would probably do a debit spread, just because of that, because it costs way less. If that makes sense. So you're going to gain or lose about the same amount whether you do a call. Yeah, definitely. Yep, P50 is the 50% chance of probability of profit, probability of 50% max profits. So we'll do, what are you, stay woke, are you bullish or bearish on Neo? And Drizzle coming over here, bullish, motherfucker. Neo to 48, okay, he says bearish. That's the first time I've heard Drizzle be bearish on Neo, holy crap. That's actually fucking perfect. So we're going to go out of the money. So it's a credit spread, 117. If we're bearish, 117 IV, we want a credit spread. It's got very elevated premium. And how you know it's elevated premium is because it's almost 10 times, the stock price. A $60 stock price should not cost $500 in premium. You go to GM, like we were just at, a $50 stock price is only costing you $200. It's a third. So it's way less. So that's one way you know your contracts are juiced. So you got your $60 strike and your 60-65. Sell to open 60. Buy to open 65. You have lots of liquidity in this contract. 21,000, 4,000 volume, 34,000 open interest, 10,000 volume. You got $5 wide, 15, what the fuck ever. So our credit spread, bid ask spread is only $20. That's so fucking nice. You generally have worse bid ask spread with option spreads. So now what we're saying is by expiration, by February 19th, we think Neo's going to stay under or break even, essentially, 6150. 60 plus 150, 6150. Not really important because I don't let anything hold till break even usually until expiration. So as long as it stays below $60, we're going to receive max credit. So as it goes down, we're going to make money. If it goes sideways, we're going to make money. If it does nothing, we're going to make money. If it goes up a little bit, for a second, we're going to lose a little bit of money. Well, then if it stays where it is, if it doesn't breach our strike, we're still going to fucking make money. And then, like, you could even, if you're super bearish on something, fuck, do two. Do a credit spread and a debit spread. Who fucking cares? It's only costing $385. Oh wait, that's a debit spread and a... Oh, that is what I wanted. No, that's backwards. I knew one of those was backwards. Sometimes I just click bid or ask wrong. 55. Like, say you're really fucking bearish on something, on Neo. Your net is only 85 debit, but your collateral is $585 because it's a $5 wide debit spread. or $5 wide credit spread. So this is different than your buying power. Your premium is different than your buying power always. Like, say you're very bearish on NEO, you have a 415% chance, $415 max profit with a 52% chance of 50% profit and an 84% chance of getting 50% of your max profit. So, I mean, shit, if I have an 84% chance of making $200, I'm fucking down. You know, like, that's pretty good. Like, spreads are super low exposure, low risk. Yeah, this is great. I'm a swing trader, and so this is great for swing trading. I focus on larger time frames, and you don't have to worry about that intraday bullshit. You wait for it to break key levels or hold key levels, catch it on a good bounce, catch it on a good breakout, and then play it for a week or two, a day. I got you. So instead of 200 a day from it shooting, it's just steady 200 a month from now. What? Huh? Stay woke. I don't know what you mean. And what? Yeah, so if you have a job, if you have school, if you have low money, these are fucking great to get into. Like, I cannot express how much this has helped me just by doing spreads. I mean, everybody has their own technique. Everybody has their own strategy. So if you collect the credit instantly, can you close the spread and keep the profits? Why should you hold it? Good question. Thank you for adding me on that. Let me see if I have any credit spreads up. Plug, actually. It's not a credit spread, but it's close enough. So I have a naked short put, a short call on plug. So if I were to close this right now, well, let me actually go to my position. So if I were to close this right now, I have 225 profits in this already. It costed me, it was 700 credit. I collected 700 credit. You have to let that credit that you collect decay. So say you collected 700 credit, say it was worth $700 when you bought it, you collected 700 credit, and then 2 days later it's worth 800 credit, now you're in a loss. But if it's worth 570, it's decaying, so you're paying the difference between the two, between what you bought it at and what you're closing it at. So we'll go back to SPY. I got a better example. I got a good example. No, we'll go Zoom because Zoom's a high IV stock, and this is something I would do a credit spread on. So you got Zoom, we'll just say 450, 460 credit spread, costing your net $235. So this $235 credit, this is the initial price. If this goes up to when you buy it, if you buy it and it's at $235, when you close it, if it's at $3, you're at a $65 loss. If you close it and it's at $1, you're at a $135 gain. So you want these to decay. You have to let your contract decay with credit spreads. You have to let it go to zero. Cool. That makes sense, right? Yeah, because you're paying the difference between the premium that you got it for, that you collected, and the premium you're closing it for. Yep, you want them to completely decay, or I mean, generally what I'll do is I just let it get 50% max profit, and then I fucking cut it. I'm cool with 50%. You don't have to. That way, say Zoom. Say you had my credit spread. I just finished. It just expired out of the money. It was fucking perfect. A little scary, but it was fucking perfect. 350, 360. Right now it's worth 385. So you're collecting this for 385. Say, where was I? Say you collected this for 385, and then it's now worth $100 or $125, but Zoom's price is at 360. We'll say instead of 380. Let's just say Zoom's price is at 360, and it's more likely to breach this. I would take the profits and cut because it's more sketchy to hold it till expiration and risk it coming down on a fucking red day or something like that. Like because all expirations are on a Friday. What happens a lot of Fridays? Sell-offs. And so if you're don't have enough wiggle room and you get a sell-off on a Friday, you could be up $200 on your contract. This contract could be worth $1 at the beginning of Friday, and then you get a heavy sell-off, and now it's fucking you lost money. And so then that's why I do it right now. This is at 32 days till expiration. The February 19th. Anything at February 19th at 21 days till expiration, if I still have that same belief in that contract, if I still think it's doing the same thing, like if I have a put debit spread or a put credit spread, and I still think it's going the same directional way that I thought before, I will either close it and look to I will probably most likely close it and look to re-enter at a further expiration. Or you can roll it, which is a whole nother advanced thing. So close it at 21 days till expiration and look to re-roll it. Why do we close till 21 days for expiration? Because of Gamma. Gamma's a cunt. And it doesn't really show Gamma right here. Gamma gets a lot heavier closer till expiration. This has a horrible gamma value. As your contract gets closer to expiration, gamma rises, theta rises. So what does that do? Your gamma affects your delta. So if your contract goes against you, if you think it's going up and it goes down, and it's closer to 21 days till expiration, it's gonna fucking affect your contract. Your contract is gonna be way more volatile than if you're further out in expiration like this. That's why I stay further out till expiration. Keep my contract volatility, which, in short, by keeping your contract volatility, you keep your P&L, your profit loss of your whole portfolio less volatile. And so if I think it's still good, if I think my contract is still good for another month, close it, get it to this next month. Don't fucking play weeklies. I will show you right here why we don't play weeklies, even with Zoom. Credit spread, just random. 40-cent bid, 180-cent ask. You have a $140 wide spread. So when you get this contract, if you get it at 92 cents, let's just say, because like what I do, like this is the midpoint, drop it down $10, you're gonna get filled fucking instantly. I don't care about $10 in the contract. I don't fucking care. I would rather get filled instantly. If I'm like being patient and I don't mind, it's a little different situation. But normally I don't fucking care about $10. So you get it at $1, let's just say. When you open it, it's gonna be worth 157 or 160. And you're gonna be almost 100% down. 60% down for a $1 contract. If it's up $60, that's 60% down. So you keep it close. Keep it on your monthlies. TOS specifically will say weekly on the contracts. Robinhood doesn't really have a way to tell, but it's the ones with the most liquidity. Weekly options blow people's account. Don't be like fucking Zaddy. Are there commissions on Tastyworks? Tastyworks has the best commissions. We'll go.
Yo, can you blow his account like totally?
I'm pretty sure.
Get the fuck out of here, no.
Bro, we haven't
Bro,
seen.
MIA, bro.
Bro, he's been MIA since fucking New Year's.
Dude, why did he do that?
Because he's a dumbass.
That's so depressing.
Yeah, that's like a 40-year-old dude at like Vegas that's like lost everything, and he's like hitting up his real estate agent to like get the deed to his crib.
Deadass.
Like he's like there's a real gambling problem like with this shit too. Like it's I mean sometimes
Yeah,
some
bro.
people can't deal with it.
The
Yeah.
people that do the best at options are people that gamble.
Absolutely, I
Yeah.
believe it.
Yeah, it's a known statistic that people that gamble are good at any derivative just because of their risk tolerance.
Yeah.
Well, like when the whole QS train was going on, he was buying like 50 contracts of QS at a time.
Bro, I can't get myself to like. I see some people when we're trading, like I'll even call a play, and somebody hit me up like, "Yo, I just threw 20 racks into your play." I'm like, "Whoa,
Bro.
son. Like, you gotta calm down. Tesla is not a 20 rack play.
Play.
You gotta calm down. Like you're gonna make your money. You know, granted, the person made 60 racks off of it, but dude, what if the trade went the other way?
Yeah, what if it didn't
Yeah, like
work?
if your default lot size is like $10 to $20 contracts, and your port isn't like 50K, like you need to chill out.
Yeah, that's why I don't even call the Amazon plays I get into.
Yeah.
Or shit like that. Like I'll tell you, like, yo, what do you think about this play? But
I don't even
wouldn't
fuck
call
with
it
Amazon because the bid ask is so wide. I can't even do spreads for them.
Amazon, Chipotle, you know, Shopify,
Yeah.
Spotify. Those are all huge players, but it's so scary calling those out because of people's blind following. It's crazy.
Yeah.
Don't be Zadaddy, guys.
So somebody was asking me about the commissions for Tasty. So it's a $1 contract. So if you got a 2-leg contract, you buy a spread, you're paying $2.30. But to close your contracts, so let's just say I'm closing this buy put right here. You don't have any closing commissions. So unlike with Thinkorswim, it costs 55 cents to open and 55 cents to close it. We don't have any closing fees on Tastyworks. And also, let me clear this. When you have Tastyworks, say somebody like Augo, somebody has a fucking $250,000 fucking account and you want to get 20 fucking contracts. You're only paying for $10 worth of contracts. You don't have to pay the commissions for those 20 contracts. They cap it out at 10. So let's just say we have 10 contracts. It's only costing you $20 in commission. Say now you want to get 10 more contracts. No extra commissions. No fucking extra commission costs. So people that like to get multiple 10, 20 fucking contracts in one time, save yourself $500 in fucking commissions and go to Tastyworks. I think that shit's definitely helped. I'll
Just
give
so
you.
know, you can also work it out with your broker. So if you use Toss, you could bring them over the Tastyworks sheet and say, hey, they're giving me a better deal over there, and they'll drop your commissions.
Facts. I'm pretty sure Playboy has in the trading platforms channel. I'm pretty sure my Tastyworks. I'm pretty sure my
I have a
Tastyworks
sheet.
referral code is on there.
Yeah, I have a sheet from, I forgot what group that I was in for. I think it was from Flow Algo. If you join their Discord, they have a thing because they use TradeStation. One of the dudes uses TradeStation, and he gets a better commission. So he
I
printed
like
out
TradeStation actually. Is that the broker or is that the for charting?
No, TradeStation's a broker. So what I was
Okay.
going to do is actually put money in a TradeStation account because you can connect that directly to TradingView.
I know.
So you can use pitchforks and take profits and stop losses with the actual visual. So it makes me feel like I'm using Tastyworks.
I like that. I was looking at that.
Really fucking interesting. But yeah.
Bet. So, is there any more questions? Did this make sense to everybody, or did this not? I know there's a ton more that I can go over, but I think this was pretty decent for basics. Just how to set up your spread, how they profit, how they make money. Generally, like I said, I don't hold them until expiration. It's just like debit spreads, just like normal calls. If it goes up, you make money, even if it's not till expiration. If it goes up, you make money. You cut it whenever you want. You can fucking like I made my ARKG. You can just use my ARKG contract as a fucking as a as an example. I had April 16th. I had the 109 129 contract for ARKG. Cost me $300. It is now worth $620. I got it when ARK was about at $100. ARKG was about at $100. It moved like $7.
How long ago?
2-3 weeks ago.
Nice.
Yeah, it
Nice.
was dope. And then it came up, got 100% profit. Market was looking a little bit sketchy, so I cut it. 100% profit, couple weeks, no fucking hardly any risk. I didn't even hardly look at this contract. I didn't even look at the fucking chart of this. No offense, like I shouldn't even say that, but it's ARKG.
Yeah, it's Kathy Wood, bro.
It's Kathy Woods and it's genomics. Like I didn't even, and it was so far out till expiration. I didn't even fucking care.
So, dude, guess what? So my girl's been setting up her portfolio, and I think Kathy Wood has been cheating off of my girl's portfolio because she's been in all those genomic plays for like a year.
That's crazy. Kathy's been in the CRISPR for a minute. Margin is okay. Yeah, you do margin. You want margin for your account. Get the one called the Works for Tasty. You want the Works account.
You're trading with an IRA account though, right?
No, not anymore. Mine got PDT.
Oh, so you had to convert it to a regular account?
Yeah, bro. I fucking
I was gonna teach you how to buy a house with your IRA, bro.
well,
Tax free.
I had 3. So this was I originally opened an IRA when I first made my spread account, and then I got PDT. I had like $3,000 or $4,000 in it. I got PDT. I didn't want to put in extra money because I just didn't feel like it, and let that 3 to 4,000 sit for 3 months. So I fucking took a 10% loss because it like when you take out money from an IRA before you're like supposed to, you have to pay a fee. So I had to pay a 10% fee to get it out of there, put it in there, and then I've just been building it with it ever since. Best idea I could have ever had, because that 3K that I used from my IRA account has made me way fucking more. But yeah, Tastyworks has a really good IRA. You can do spreads too. ARKX, is that the space one?
When does X come out?
I don't know. Here, I'll even go to mine. Oops. What's the limit for this year? I don't know. For IRAs, I don't know much about them, honestly. Do you guys got any more questions for me? Did that make sense to everybody on how to set them up, on Robinhood? I'll get videos for Webull and all that other shit. I I don't fucking use Webull or anything like that. I use TOS and Tastyworks. TOS for day trades, Tastyworks for your spreads and my swing trades. I have 2 accounts, one day trading for a cash account, one spread account for Thinkorswim. I just think it's worth us Webull users just to get Tasty. I fucking agree. Tasty is way better than Webull in my opinion. Unless you're doing pennies like Tyler. Because Weebull's really good for his like penny scanner type shit. This doesn't have any pennies in that shit. Tastyworks is pretty good. Is good for fucking spreads. The fills you get on Tastyworks are gonna be 10 times better the fills you get on Robinhood. I can fucking guarantee it. You're not gonna be sitting there waiting to get fucking for a contract to fill. It's instantly.
You know, that's why I don't use E-Trade.
E-Trade's horrible for it.
Yeah, because I was trading once and I was in this other group and I called out this Tesla play and my boy got into the Tesla play and he had put in a sell order for the Tesla play. So let's say Tesla was trading at $400. He had a fucking $450 call and then Tesla started trading the other way. So IV was killing him in the contract, right? So it was a $1,000 contract for $10. He goes and he sets a sell order in E-Trade for like $3, right? Because that's how low it went. Tell me how he cancels it and he's like, fuck it, I'll just let it run. He got the cancel confirmation from E-Trade. Tesla fucking goes to like $500-$600. It was that day that it just kept fucking going. Right?
Shit.
That contract was worth close to $20. Tell me how E-Trade sold his contract at $3
Yep.
2 hours after he received the cancel order confirmation, and they didn't want to refund his money for the contract.
E-Trade fucks you, bro. I used E-Trade like when I first started trading options, and I was like, this is garbage. I'm not fucking
Unless you have
using it.
E-Trade Pro or whatever, but even then, I don't think it's good in my opinion. I'd rather stick to like TradeStation, Tastyworks, and Toss.
Yeah.
The same thing.
Yeah, because like for everybody that doesn't know, the maker of Tastyworks, his name's Tom Sosnoff. He created Thinkorswim. So it's very similar. They're easy to use. Like,
yeah, he wanted something technical and he wanted something visual.
yeah.
He kept the visual and sold the technical.
Yeah. And so like right here, if you guys see this bid-ask spread is 288, 295. The midpoint is 2.91. For fucking Robinhood, you'd have to drop it down to like 2.8 or something. You'd have to go so far for you to actually like, you'd have to pay way more. You just, boom, couple cents, and you'll get filled fucking instantly. Robinhood's ass, you'll have to hit it at the ask or some shit. Tasty, fucking, you could probably get filled instantly, like 1 cent. But I always do like 2 or 3 cents, boom, instant fills. I never worry about fills. Yeah, so Tastyworks is great, man. Like, I can even go over, one day I'll go over, like, every single different spread fucking play you can do. Like, I just went over the basics of vertical spreads, credit spreads, and debit spreads. There is so much more of a calendar spread. Honestly, I don't know.
I thought we were gonna get into broken wing butterfly iron condors.
I mean, we can. Those are a little more advanced. I was going basic credit spreads, like a broken wing butterfly. Actually, that would be fucking fire on the SPY right now. Honestly, that's a short broken wing butterfly. I want a long. 280. Broken wing butterflies are fucking expensive though. They're stupid ass expensive. But you're fucking like your probability of profit's so good. You get such a high probability of profit.
For you guys that don't know what that is, it's basically like a bunch of contracts, and then you leave one end open with nothing covering it. So that's why it's called a broken wing, because there's nothing covering that other call. So it's a little bit
No,
more
it's called broken wing because your wings are different or separate. Like a normal butterfly would be buy one, sell two, buy one, right next to each other like that. And then with a broken wing, you're
It's separate.
you're going out one and then like out 10.
Oh shit! You see, that's why I don't do these things. You just copy Hunter's moves, kind of like if you were in school trying to cheat off of somebody else's test.
And so like for a normal butterfly, it would be so you would be selling two of the 385s, buying one of the 384s, and buying one of the 386. Then as long as it stays between 384 and 386, you make money. That's bullshit. With a broken wing butterfly, you sell two of the 385s, you buy one or two out, and then you buy another one 5 out, collecting net 77 cents, and you make money as long as this motherfucker stays above 388 by expiration. Actually, this play looks fire right here. Low key. Because if it goes up, you make your max profit. If it closes on expiration at 385, you make your max profit. If it expires worthless, then you collect the full credit. 77 cents. It's a win-win. So your analysis tab on this bitch. Let me get rid of my puts. Your curve. Let me widen this out a little bit so you can see these a little better. 395. So notice how this is I'm going to have to widen out even more just so you can see it. See how it's a 370. See how it's like it's going out. 405. It's got this triangle right here. This is where you get max profits, but if it doesn't get to this triangle, you still collect your credit. Broken wing butterfly is completely a whole new thing. Calendar spreads, though, that's a different thing. That's another one. There's so many different ones. Hey, Ago, do you know much about calendar spreads?
Nope.
Damn it.
I'm not gonna lie. Nope.
I was looking.
Don't know shit about nothing. I just know about put spreads, and call spreads. Debit and credit spreads, but I don't even know the whole gist. So that's why I follow your trades. And Iron Condors, I think I played one or two of them, and I did not understand what I was doing.
I fucking don't really like Iron Condors.
It was when the market was running sideways.
This is the best time to do them.
Iron Condor, I think it was on like AAL or something like that. It was like fucking back in June when they weren't doing anything. They were just trading in a fucking.
With spreads too, it's cool because you can adjust your shit. Like I have an Apple, we have our Apple fucking 135, 145 credit spread, or put debit spread. I was looking into rolling this bitch out till the $60 date. So right now I have a 135 for February, rolling it out to 145 for March, collecting an extra 67 cents, turning this debit spread into a calendar spread, and then if it stays below 145 by February, you collect the full 155 credit from that one, and then you have just a naked call for $100 for February for March. 145 call for March for $100 instead of $200. But that's a whole different, like, that's where you get really advanced. I haven't done much calendar spreads, but with the calendar spreads are really good for like a choppy ass market like we have. So I'm looking to get into them. I got a YOLO McDonald's one because it's a fucking McDonald's is such a slow stock. So 230, 230. So a calendar.
You better have gotten like 5 months on that shit time or something.
I just got 2 months.
Mickey D's. It wasn't that great, man.
That's
I
what
think I
I'm.
still have the contract, and it's like 99% loss.
That's like that was my key though, because calendar spreads are neutral. They're pretty neutral positions, and so if it doesn't have to go up, you can still make money as long as as long as it goes like sideways or goes up gradually. So like if it stays under 230, I'm gonna collect the full 70 cents credit. Like that's gonna be a free $70. And then if it goes up a little bit, this will still make some money, and I'll be able to cut that, collect the full 70, fucking be happy. But your analysis tab will never. It thinks these things are retarded. Like it goes stupid when you do calendar spreads. Like what the fuck is this shit? It has no clue because it doesn't know how to calculate it. That's where options profit calculator comes in. Yeah, I pretty much mainly do verticals. Keep it simple, stupid. KISS. KISS. Keep it simple, stupid. So I learned that in high school. That's what they always told me. Any thoughts on GEVO? I don't even know what GEVO is. What is it? So here's, like, if I don't even know what a stock is, it's got no options. I won't even play it. I don't like shit without options. See, Tasty's dope, too. You can do liquid symbols. Your fucking... Zom is a penny stock. I don't know that shit either. No offense. That's Tyler, and Broham's pretty good at pennies too, but yeah, I don't know that crap. I peeped at a chart real quick. It looks like ass. Looks super extended, then dropped heavy. Tasty has a bunch of pre-made watch lists. This is where I get a lot of my shit too, because everything's really volatile. Everything's really liquid when they have theirs. Natural gas. IV rank is the historical IV. What's the IV now compared to how it's been? I never knew that. Have you ever heard of the TZA algo?
No, what is that?
So it's like SQQQ, but with small caps.
No, that just sounds dangerous. I'd rather just play puts on IWM.
That's what I'm saying. I've never heard of this. It's $5.
You got to be careful with those because people don't really understand that those type of ETFs will do a reverse split or a split at any given moment, and you won't know. So you'll get caught up in SQQQ reverse split, and your contracts are fucked.
Yeah, I don't really play that shit. Like,
yeah, that's why I just play. If people want to hedge, I'm like, yo, put puts on QQQ. Or IWM. Don't buy SQQQ.
And the thing about SQQQ and like TQQQ and like these the direction, like the leverage ETFs, they reset every day.
Yep.
And so so they might go 5% one day based on that day's movement. The next day they go based on the next day's movement.
Yep.
They change. They don't fucking
and
continue
they're a depreciating asset, so it's never going to continue to go. That's why you don't buy VIX unless you know what you're doing. VXX, don't do that. Don't do that. You'll be pretty mad at yourself if it goes from $17 to $5 in one day. You'll be like, what the fuck?
I can't fucking believe CrowdStrike's at 220, bro. That's so wild to me.
CrowdStrike is.
I definitely believe it. It should be that high, but it's just.
I think they should be higher, maybe like a 250-ish around there.
I lost track of CrowdStrike at 150. I stopped looking at it really, and now it's at 250, and I'm like, fuck, I missed it.
That's like Square and myself. I wanted to buy 120, and I was like, come on, look at it now. But yeah.
Are you still holding the iClean debit spreads? Yes, I am.
You have all those debit spreads you posted, right? You didn't exit because I didn't look at them.
Oh, absolutely. I still have it. I didn't exit anything on Friday just because I was like, I have time on all of them. Like, why? I didn't want to exit on one bad day, you know.
I feel it.
I try not to, and
Ah,
I didn't average down on anything too, just because it was like, I might as well wait till Monday to average down. Yeah, I have the 35-45 debit spreads for iClean.
when you say average down, do you mean average into the play or you averaging out of the
And average into it, yeah.
Yeah, cool. Just making sure.
Because I think I got this iClean play at, let's look. I had a decent scalp on fucking Russell last night. Yeah, I got it at 217. It's now worth 173. I probably won't even buy another one of these. It's only down a couple bucks. I probably won't even average into this one. XLE is the one I'll probably average into. XLE and XOM. But I bought short-term puts just in case to hedge my deltas. I'll go over that shit with you guys too a little later. How hedging their deltas is your whole portfolio can work. XLE, what else did I fucking call last week? I don't even know, bro. I'm in low-key quite a bit too much. But I'm good at hedging. You said you did SPY puts. Yeah, I put in SPY puts. I did SPY puts, I did IWM puts. And then what I also did is I got short-term puts on most of my contracts, like one of them, because say my contract had, we'll just go XL even. I had two of these, which was a 70 delta. So I hedged that with a short-term January contract, which was cheap as fuck. Cut my deltas in half. I grabbed two of them, so now my 70 delta went to from 70 to 40. And then if it drops on Monday, this will make money. That money that I make from my put, I can use to average down if I believe it's still going to go up. And so that's another thing you guys can do. Like I did that with Apple too. And I'm not going to call all this shit because it's too fucking hard sometimes. I grabbed a small debit spread on Apple, 15 delta, to hedge my debit spread that's got to hedge my call debit spread that's got a 15 delta. So now net, if Apple goes down, I'm still gonna be fine. It's not gonna affect my contracts too much. Yeah, it was a net of a negative 0 delta, pretty much. Negative 0.17. So all the money I make from that I lose on this, I will make on this short-term position, and I can put it right back into it if I want. Yeah, it's like doing an Iron Condor, just legging into everything. I'll hedge, cut them, hedge, cut them. I'm very quick with it sometimes. You gotta be quick with these games. Alright, it's almost noon. You guys got about, I'll say 3 minutes for more questions if there's more questions, and if it goes longer than that, I'll go till noon. If not, I'm about to head out and start showering and everything. We can do more of these within the next week or so. Feel free to hit me up if you guys have any questions. We're gonna see how the market goes here soon. Our futures open right now? Let me see.
I don't think so.
Our,
It's Martin Luther King, so I think everything's closed except for like Forex and crypto.
it's closed. They were open last night. That's why I was really confused. Yeah, Russell was cool last night. I got it for one. I mean, cool. Futures open at 6 p.m. Eastern time. Yep. Yep, they'll open in 3 hours roughly. 3 hours and 15 minutes. Did you go over any swing debit spread this weekend or did I miss them? What do you mean? Swinging debit spreads? Or the ones that I went over? Or the ones that I'm in? Oh, like TA streams? Yeah, we did a TA stream it was just a basic stream. You can go to the videos, and it's in there. Hashtag videos. I don't know. Honestly, I'm not really looking to get into anything right now. I wanna see what happens. DXY was being a cunt this last few days. Is DXY open right now? Yeah. What's fucking DXY doing? DXY is going down.
What is that?
Dollar bill index.
Um,
It's retest. See, DXY just broke out of inverse head and shoulders.
oh, DXY. I thought you said DX.
Oh no, DXY, the dollar bill. It just broke out. Retest. Bruh, I don't like this. It just broke the trend, the downtrend it's been in since November 3rd. Broke out of this inverse head and shoulders. It's retesting now. We'll be looking for DXY to drop back below this fucking level right here, back into the 90s. But
Man, weed smells like burnt weed.
oh yeah, thank you SBMB. I do that a lot. All right, I'm gonna turn off I'm gonna stop recording this now, so it's not too long. So we're done doing spreads.